Good afternoon and a warm welcome from my side. My name is Ludwig. I'm Senior Vice President of Communications and Investor Relations at DEUTZ. Today, I would like to present you our 9-month results. Thank you very much for Seat 11A to giving us this opportunity. Before we start, please have a quick look at our disclaimer. To kick it off, I'd like to walk you through our key operational strategic developments. First of all, new orders were flat in Q3, but after 9 months, we were slightly down versus the previous year at 1.435 billion euros. The book-to-bill ratio after 9 months stood at 0.93%. But that is no reason to worry. I'll come to that in a minute. Unit sales of DEUTZ engines increased 5.1% to more than 137,000 units. And this growth is well reflected in our revenue development, which grew disproportionately by 10.3% to 1.54 billion. And even more important for us is the very positive development of our adjusted EBIT. With a growth of almost 27 million year over year, we came in at 92.7 million after 9 months. This translates into an adjusted EBIT margin of 6%, up 1.3 percentage points versus the previous year. And the driver behind this is our classic segment, which was able to post an 8.8% margin after 9 months. This strong positive earnings development is also well reflected in our free cash flow development. We were able to improve our free cash flow by almost 57 million to minus 13.4 million. And we can also announce that our earnings guidance for the year of 2023 is going to be raised. While we will keep the revenue number flat at 2.1 billion, our new EBIT margin target is 5.3 to 5.8%, up from approximately 5% before. On the strategic side, also 2 highlights in the last quarter. First of all, we received our first seal order for a hydrogen genset from China. This is a small-scale production run of 100 units, but it's the first order with significant numbers. And also, in September, we presented at the DEUTZ Event Week a Capital Market Day as well as a Partner Day. We were able to present our Dual Plus strategy to capital market participants and our business partners. Now coming to our market outlook for next year, because that is something that a lot of people are asking us, especially with respect to our order intake development. First of all, we see that across the board, more or less stable development is the most likely scenario as of today. In all our 3 regions, we believe that there's no significant downturn visible. True is there is no strong growth, but we believe there's a solid basis for a continuously high demand as we have seen it this year. And this is also something that is reflected in our order backlog. As you can see here, we have given you an overview over the last couple of years, the development of order backlog. And in the pre-crisis years before Corona, when we sold 200,000 units per year, our order backlog was significantly lower. Now, the order backlog in the last 2 years has risen strongly because we had, from the customer side, increases to secure limited capacities, and also because there was a very strong demand across the board. What we're seeing this year is basically a normalization of the demand from our customers. And we still have a very high order backlog despite some headwinds from Asia. And these order backlogs are driven by our strong regions and the Americas. So as we can see here, before the pandemic, orders on hand were at around 500 million maximum. The increase in 2022 to 676 million was mainly due to supply chain bottlenecks. And then, to deal with that, end of 2022 for 2023, we initiated a so-called fixed volume program. This led to a further rise of the order intake to 773 million at the year end. And as you can see here, at the outlook at the time, end of 2022, 40% of our unit sales planning was already in fixed orders. Today, it is only 90%, as the order level is normalizing and also the orders at hand are returning to the normal levels we have seen before the crisis, basically, as the supply chain situation eases and we have not initiated another fixed volume program. So we believe that going into 2024, we have a stable outlook as we're only seeing a normalization of the ordering behavior of our customers and not a massive decline. Another important event that we were able to adjust this week is that we received our first order for hydrogen gensets from China. This is a small-scale production run with 100 hydrogen-powered gensets, where our business partner is the Zhongguan Summit Enviro Protection Co., a government-owned company. The order was only received at the beginning of November. With these hydrogen gensets, they will initially be used with gray hydrogen, which is obtained as a byproduct from a coking plant gas, and we will save up to 800 tons of CO2 per genset. This is the starting point for the subsequent development of a climate-neutral infrastructure for hydrogen in China, because at a later point, the hydrogen will be changed into green hydrogen and will be completely climate-free. The Chinese government objectives to ramp up a hydrogen infrastructure offers further potential for significant growth. And as said before, the scheduled start of the series production of our hydrogen engine for the stationary use is end of 2024. Overall, with this win, we can show that we offer suitable solutions beyond our classic drive portfolio, also in our alternative drivetrain offerings. Now, let's have a deeper dive into our results for the first 9-month period. I already talked in length about our new order development. So let's focus on the unit sales. Overall, unit sales are down 2.5%, but this is only driven by Torqeedo, where we see a significant decline in certain areas for leisure boat applications. Our classic DEUTZ engines, on the other hand, grew by 5.1% to more than 137,000 units. And even more important for us, the revenue number grew by more than 10%, as the price increases that were implemented over the course of last year and also partly this year, as well as the phase out of some lower average revenue price older engine models, have led to a significant increase in our revenue number. The orders on hand remain at a high level at 666 million units at the end of September. Now let's have a look at the revenue breakdown in detail. First of all, if you look at it on a regional level, you can see that on all regions we were able to post growth. Europe and Germany, a high single digit, and in the Americas, our most strongest region, almost 20% growth. Asia Pacific, as I told you on the half-year call, is a little bit weaker, as especially in China, business at the moment is very slow. Of course, also positive for us was the development in Africa and Middle East with a growth of even more than 20%. If you look at the revenue breakdown by application segment, the material handling sticks out. This is a business which is mainly done in the Americas, so there's a strong correlation to growth in the Americas there. Also, on the construction side and the stationary equipment side, we're able to post some nice growth. And what we're extremely happy about is that our service business continued to grow disproportionately by more than 7% to 360.5 million. With that, the service segment, which is highly profitable, is already the second largest business segment that we have. Miscellaneous and agricultural machinery was a little bit weaker, with basically a small decline overall as the market demand is a little bit slowing down. But even more important for us than the revenue development is, of course, our improvement in profitability. After 9 months, the adjusted EBIT improved to almost 93 million. Drivers here are the high revenue in the classic segment, positive product mix effects, our market-oriented pricing policy, and the expansion of the service business. On a quarterly basis, we were able to post a quarter with 30.2 million in adjusted EBIT and a 5.8% adjusted EBIT margin. This is, again, a significant improvement over the already good quarter in the previous year. Our EBIT margin before exceptional items rose to 6% after 9 months, and the net income before exceptional items grew also significantly to 66.5 million, leading to an EPS of 53 euro cents. Overall, our market-oriented pricing policy and our performance initiatives are continuing to bear fruit. Now let's have a look at some other important KPIs. Our R&D spending increased slightly by 4.4%, but due to the strong top-line growth, our R&D ratio decreased to 4.7%. Capital expenditures, on the other side, had a stronger increase by almost 40%, but this is mainly due to the acquisition of IP and license rights that we talked about already in the first quarter, where we had this cooperation with Daimler Truck. This alone accounts for roughly 52 million of the capital expenditure in the first 9 months. Adjusted for that, we're actually down year over year. On the working capital side, we also have to show a strong increase here. Reasons are that we built up inventories to safeguard production, and also we introduced our third shift in the course of the third quarter. Also here, we need more safety stock to ensure that production runs smoothly. At 20.3% working capital ratio, this is of course a number that we're not too happy with, implementing a lot of measures to bring this number down towards the end of the year. Despite the strong growth in working capital, we were able to improve our cash flow figures across the board. Cash flow from operating activities grew by more than 70 million to 58.3 million. And the free cash flow grew at 56.4 million, although it is still negative after 9 months. For the full year, we reiterate our free cash flow target before M&A activities of a mid-double-digit million euro figure. The net financial position declined a little bit over the year, as we have still a negative free cash flow, and also we paid our dividend in the second quarter. But our equity ratio remains well above the target of 40%. After 9 months, we'll increase our equity ratio slightly to 45.7%. So we are well financed to fund the transition of our business. We also increased some bilateral credit lines and have unused credit lines totaling around 185 million at the end of September. Now let me touch our full year guidance for this year. After 181,000 engines last year, we were targeting the upper end of the 175 to 195,000 range that we had initially given you in March. Now, after 9 months, we can refine this to 185,000 to 190,000 engines for the full year. We're keeping our revenue guidance, though, stable. We are expecting approximately 2.1 billion in revenue for the full year. And after the strong first 9 months, we're able to increase our adjusted EBIT margin guidance from approximately 5% to 5.3 to 5.8% for the full year. And as said before, our free cash flow guidance also remains stable at a mid-double-digit million euro amount. Let me close with a quick look at our medium-term targets based on our Dual+ strategy. They have not changed. We're looking at revenues of more than 2.5 billion by 2025. The service business share of revenue should be around 600 million by then, and the adjusted EBIT margin of the group should be between 6 and 7%. And we can confirm those medium-term targets after the first 9 months of this year. With that, at the end, we will be visiting a lot of different places and be attending various conferences until we release our full year results on March 19. So I hope to see you around at one of those conferences, or if you have any questions, please do not hesitate to give us a call at the DEUTZ Investor Relations Department. Thank you very much, and thank you, Seat 11A, for hosting us today. Have a great day, and talk to you soon. Goodbye.